Station. And Session 6 of RSM's 2021 Tax Summit Week is Managing Post-Merger Risk. At this time, I'm pleased to turn our call over to our first presenter, Ariane Herrenhines. Ariane?
Thanks, Allison, and good morning. Again, I'm Ariane Herrenhines, National Leader of RSM's FACA and Global Information Reporting Team. We're going to be talking today about managing post-merger risk and how automation can improve your global tax reporting obligations. With me today is George Pachik from our tax technology team. I'm also joined by Justin Gurney from our mergers and acquisitions tax services practice. And we are absolutely thrilled to be here today. Let's run through our agenda today. We'll be talking about ways that you can maximize technology during the post-merger phase to ease the burden on your tax and your finance teams of managing your tax reporting and withholding obligation processes. So we'll start just to level set with why this is important. We'll talk about managing your data post-merger. We'll run through some technology and developments, and also we'll be including a discussion about our solution. We have a technology demo, and we'll leave some time for Q&A at the end. So looking forward to the discussion. Hope we'll have an interactive discussion today. Lots of good information to share. But just to level set, I want to start by just saying that the way that we're doing business today has clearly changed. We've seen an increase in merger and acquisition activity, and we've also seen more heightened focus on information reporting and withholding requirements. So we thought that talking about a very common issue during the post-merger phase, which is handling your tax information reporting and withholding obligations, would be appropriate. As we've seen, companies initiating acquisitions and who are participating in divestitures or carve-outs and looking to manage their data really have a daunting task of being able to gather, compile that information. They need to migrate data, they need to move employees, and they've got to perform a multitude of key steps in order to ensure that they'll be compliant and are ready to comply with their information reporting and withholding requirements going forward. So why is this important? Well, one of the things that we've seen is that with the new administration, Biden administration, has really been focused on trying to identify ways that they can increase enforcement around withholding and reporting requirements. They've introduced a number of provisions that will require companies to provide more data, more information to regulatory authorities. And they're looking to enforce those requirements. And so to the extent that we can be prepared to comply with this by gathering the data that's needed and being prepared on the front end, irrespective of what ultimately is passed, companies will be better prepared to deal with this. And so what do I mean by information reporting and withholding? Well, every payment, most payments that companies make, whether it be inside the U.S. or outside of the U.S. to a U.S. person or a foreign person, in some respect, that payment may or may not need to be reported to a regulatory authority. And what the U.S. government is doing with these provisions that have been introduced is looking for a way, a mechanism to better match income that's being reported by companies to the information that's being reported by taxpayers on their tax returns. So they're looking at this as a way to be able to collect the information that they need to audit and examine that information through enforcement. And these revenue-raising provisions basically say, hey, we can gather and collect more information, which will enable us to have better insight on what income our taxpayers are receiving to improve compliance in this space. They've estimated that there's $166 billion in revenue, so $166 billion gap there that they can address just by improving the amount of information and the compliance with the requirements to provide that information to governments. And it's happening around the world. It's not just the U.S. where we're seeing this happen. Other governments have taken on these provisions and taken the position that as we require more information from taxpayers, we're better positioned to be able to collect the revenue that we need to support what we're doing. So whether that's the infrastructure bill here in the U.S., the Reconciliation Act, Treasury's Green Book, they've all consistently had enforcement provisions around these revenue-raising provisions that are connected to information reporting and withholding. So as a result, you'll have more information that you need to gather in order to comply with these requirements. So what are companies doing? With this increased number of mergers and acquisitions that we've seen, they're trying to comply with requirements. But in order to comply, if you've acquired a new business, you need to know what information they have. You need to know where that data is, and you need to know how to go out and get it. So in order to file U.S. tax information returns like 1099s and 1042 forms for the new group, for your new group at year end, if you closed in October or November, these returns are generally due starting in January of the following year. Companies are realizing that the information that they need for these returns could be stored in multiple systems, decentralized systems that they may or may not have access to. If they do have access to them, they still may not have personnel resources. They may not have systems themselves internally to be able to do the proper analysis of that information, to turn it around and to aggregate it, consolidate it in order to comply with their filing requirements timely. So the scramble here is on. Meanwhile, on the other side, we've got the Internal Revenue Service, who has really improved their data analytics recently. They've launched several campaigns that are focused on enforcing these tax reporting and withholding requirements. They're able to pull the information faster. They've improved these data analytics and can spit out penalty notices sooner. We're seeing penalties being assessed faster. They're being assessed sooner, and they're more. So we need to be ready to deal with this risk, to manage it. In order to manage that risk, buyers really need to consider an automated solution for gathering and consolidating that data that should be reported. And when you think about the way that you can do that and how quickly you'll need to do it, you realize that manual processes, while they may have worked previously, in today's environment, they become less and less effective, present more and more risk. And so in thinking about that, we want to talk a little bit about, what some of the common M&A strategies are and the issues that we see post-merger. Justin, would you mind covering some of that for us?
Absolutely, and thank you for the introduction. Justin Gurney here, as mentioned earlier, senior manager in our M&A tax group, and I'll spend maybe 5 to 10 minutes along with Ariane speaking about some of. I like to simplify it and say the current environment of the M&A deal space that we're seeing. As many of you know, that we have seen a significant increase of M&A transactions over the past year and a half. Not only have we seen an increase in M&A transactions over the past year and a half, we've also seen a decrease in the timeline and how quick you have to get a deal done. When you're speeding up the process of getting a transaction done, you may not be focused on some of these post-closing merger integration transactions or compliance, getting the proper information, pulling it from whatever ERP system that they're on. How does that tie into your ERP? That's not really what we're doing on our side, but from an overall strategic approach, where that timeline is short. It has shortened. So what's happening is some of this stuff is getting pushed and having to comply with it, as Ariane said. Post closing, your timeline may be shorter there as well. So in the deal space, I would say when you look at the transactions that are being performed out there, it is a very wide array of what we're seeing. Anything from carve-outs to where we have clients that do multiple tuck-in acquisitions, so multiple asset acquisitions or stock acquisitions. And as you keep adding companies into your overall strategy company or platform company, you are adding in new reporting systems. And where you see some of it may not matter as much if you're only dealing with, okay, we're only inheriting 5 independent contractors, or, in some cases, where it could be even more relevant, where you're inheriting, you're acquiring a business that utilizes a lot of independent contractors, landscaping companies, record companies, entertainment companies, movie production companies that all use independent contractors and have to make 1099 payments in January of the following year. So we are seeing a lot of that. Deal structure, as I mentioned earlier, it's a wide mix: stock, asset, maybe less on the merger side, but definitely a lot of stock and asset deals in these transactions. And I think as you go through, as you're sitting there gearing up to do a transaction, some of these issues that we're going to talk about today are great items to think about upfront, right? So you're not chasing it down post-closing. And maybe at that point, I know, Arian, you maybe had a couple points you wanted to add to this slide with respect to specific examples. So maybe I'll pause here for you.
Sure. Yeah. Thanks, Justin. I think you hit a couple of them, but thinking about, some of the transactions just as examples of what we've seen, one that resonates with me, you mentioned independent contractors, and often we do see issues around reporting, whether it's the types of vendors that they have, right? So if you have an entity, you acquire this entity and they have several independent contractors, you need to think about whether or not where those independent contractors work, whether you have the ability to report on a 1099 as you would be required for those workers. There may be state information reporting requirements in states that you haven't previously reported in, that now you need to register in, as an example, where you may not have previously been registered. Also, in thinking about some of the common transactions we see outside of the vendor space, if you are a partnership and you acquire new investors, for example, as a part of the deal, you now need to collect more information about those investors in order to comply with these reporting requirements. You need to collect new W-8s. Well, where are they? Those are the tax withholding certificates that would be required for your foreign investors. You've acquired these new foreign investors. You now need to take time to collect that documentation, figure out where it's stored. Maybe you need to update it if it's expired. And all of this will impact what your tax reporting and withholding requirements are. So Justin, just wanted to highlight those few points. Do you want to talk about some of the common issues that you guys see with respect to certain structures post-close? I mean, I know that information reporting is very a very key issue here, and do you want to speak to some of that just as examples across the board?
Yeah, and maybe a point I did want to bring up with respect to carve-outs. If you are doing a transaction that is a carve-out transaction of let's say a larger conglomerate, a larger U.S. corporation, a lot of the times you end up on some sort of transition service agreement, and maybe the sellers are going to handle some of the reporting on their side, obviously for a fee on our side to have them handle the TSA and some of the compliance reporting. So as you think about how more effectively can I streamline our reporting process, could impact how quick you can get off the TSA and be operating on your own, and centralize some of this reporting into your reporting system by using the technology that George will demo later. I would say, Arian and myself, we've given a few examples related to, specifically to non-employees and 1099s. And, we are seeing it. We were also seeing it in the private equity space. If, we have companies that are doing leverage distributions and that are going to require some of these, reporting, come in, filing these 1099 divs in January of the following year. So we are seeing that as another example. I think, the technology that's out there is really just, a tool to really enhance kind of what we're doing manually and hopefully ease the system up as you are trying to combine a bunch of different systems into yours. And I think really that's what we're seeing in general from a very general perspective. That's what the market's seeing. That's what some of the headaches we're hearing from some of our internal tax and controllers and accounting team members at our clients. So maybe I'll pause there, Ari.
Yeah, thanks, Justin. To your point around the private equity space and also just financial services in general, I think very important to note here also what we're seeing is as companies acquire new entities in their structure and move into new jurisdictions, just thinking about what some of our clients are doing offshore, they soon realize that they also now need to comply with this Foreign Account Tax Compliance Act, maybe that they weren't required to comply with in different jurisdictions before. And that regulation basically requires certain reporting of information on investors and account holders by financial institutions in certain jurisdictions that have entered into agreements with the U.S. around this reporting. And so to the extent that you move into a new jurisdiction, you now face the monumental task of gathering information on your investors and account holders and being able to report it out to that specific jurisdiction who shares information with the U.S. government. So again, a host of data points that you need to think about in order to comply with these requirements, and even more important today with the current administration's focus on those things. So thanks, Justin, for sharing that backdrop. But as we move into some of the things that you should be thinking about post-close for managing now these potentially new data requirements, whether it's in a new jurisdiction or it's for a new information return that you didn't have to file before, or new information that you need to collect on your vendors, your account holders, your customers, or your investors. There's certain things that you should be doing in order to comply with these rules. So I want to just spend a few minutes talking about those. One of the things that you should be doing is making sure that you review your new structure, right, to figure out who are the withholding agents in my structure and what are the payment streams, what types of payments are being made. In order to comply with these requirements, those potential withholding agents will need to be able to file the returns timely. And once they file the returns, they need to make sure that they're able to report anything that's reportable, to determine what their withholding obligations are, and to do that timely. The other thing is that you need to make sure that you've identified the systems where there is global information reporting, relevant data that's housed across different entities and business units that may require reporting. In order to know what those systems are, you should also have someone that's designated as the owner of this process for determining where that relevant data is housed. Thirdly, make sure that you can flag those payments that you're manually processing outside of your systems and identify any opportunities to automate. Moving information across and accessing information in your legacy systems may be challenging. So we want to know where those systems are, where that data is housed. And then also, you should make sure that you've identified, as I mentioned, and registered to the extent that it's required, any newly acquired entities that might be considered reporting foreign financial institutions under the Foreign Account Tax Compliance Act, which I just mentioned. Another important thing to do is to prepare new tax withholding certificates and provide those to your banks for your newly created entities. They're going to ask for new W-8s for your foreign entities and W-9s for your U.S. entities. Make sure that we've prepared those and distributed them accordingly with the new information on your entities. And finally, making sure that you've collected any required tax withholding certificates and have properly stored them and verified that the ones that you have on file are valid, right? There's a host of data. There are over 50 data points on these W-8 forms now. And I should also mention that the IRS recently published new W-8 forms, which are the withholding certificates required for non-U.S. persons. So make sure that you're collecting the latest and greatest of those from any newly acquired entities, shareholders, investors, and vendors. Now, having talked about, just to level set what the requirements are and really what the issue is here now, I'd like to turn to George to run us through a little bit about what our solution is and the service offering. George?
Thanks, Arian. Yeah, so this slide's essentially a use case or a case study on a prior project that illustrates where these tools can be used and where these challenges can arise. Essentially, a large multinational company was in the process of a merger and also simultaneously rolling off of a transition service agreement from a prior deal that they had gone through. They had multiple systems containing varying formats and structures of data that would be required to prepare their 1099 forms. So what would typically be a process of an individual collecting all these reports from varying systems, setting up an Excel workpaper and importing the data, pivoting it, using VLOOKUPs, a lot of copy and paste, a lot of circling back and trying to validate the information that they receive. There were challenges as far as where both of multiple companies would have paid the same vendor, and that information needed to be consolidated for the information reporting. And then in some cases, you might have vendors with the same with different names and different just how they were entered in different systems, but they might have the same tax ID number. So the lookup process and the data wrangling was cumbersome. It was something that they had tried to look at doing outside of the TSA in the past, and were kind of worried about how that would go in the short amount of time that you have to get the 1099s out after the financial year closes. So what we did was we came in and we used a tool called Alteryx, which is an ETL tool. And ETL stands for extract, transform, and load. And it's essentially a customizable solution where you can establish input connectors that bring in data from Excel or from varying systems. You can use a series of tools to transform that data, pivot it, join it, get the data structured the way that you need it for reporting. And then you output it into a report that essentially feeds directly as an import into the tax compliance software for the actual physical and e-file the 1099 forms. So we developed that solution. We processed the data and saved a phenomenal amount of time on the back end from them having to go in and do this data wrangling internally. And then as an additional part of that engagement, we helped establish the shared service center and their processing of new vendors, new invoices in a way that they can, that the process would be easier down the road and more compliant with what they needed to do. A typical engagement like this would start with a discovery workshop to understand the current landscape, what challenges they were facing, what their data looked like. We would develop the tool, we would take that information, develop a tool, test it, deploy it either on their systems or in our cloud. And then we process the data and then hand that data over to our processing center to process and file the returns from there. And I think I'll pass it back to Aryan to cover some of the new developments in the technology and post-merger information reporting space.
Thanks, George. Just really quickly building on that, you can see very easily how managing that data and having control of where your data is and knowing what data is required to comply with these requirements is very important. With that said, I will turn to some of the new developments that we've seen with the current administration that may impact how much data you need to manage, when you need to manage it, and how. One of the most important things that the current administration has proposed that will impact your data requirements if you have entities in your structure or you're considering acquiring entities that have digital assets, the current administration has been very focused on digital assets and enforcement of potential reporting requirements there. Up until this point, we have not seen a significant amount of, or we haven't seen any formal legislation requiring reporting of digital assets, but we anticipate, based on some of the current proposals, that there will be something that potentially makes it through. One of the things that's been proposed is an expanded definition of brokers, which would require, a very broad definition that would require expanded reporting of crypto assets held by exchanges, and it includes hosted wallet providers with respect to crypto assets, and that's going to be relevant for any returns that are filed after December 31st of 2022. We also have seen a proposal that would require treatment of digital assets, any payments of $10,000, over $10,000, to be reported on IRS Form 8300, which is also new. The 8300 form isn't new, but specifically requiring the reporting of digital assets, treating it as cash, and reporting those payments of $10,000 or more is going to be new. So again, more data points to consider so that you can comply with this potential Form 8300 reporting. We've also seen some other mandates that will impact the amount of data that you might be required to report. One of the important points is that the administration is looking to cut down on the number of paper filed returns, right? And so that basically is going to require you to file electronic returns, electronic information returns, some forms that we hadn't previously been required to do electronically, including that 8300 form that I mentioned for reporting cash transactions over $10,000, and Form 1042, which is for reporting payments that have been made to non-U.S. persons, payments of U.S. sourced, fixed, determinable, annual, and periodical income on an annual basis. That 1042 summarizes all of the payments that you may have made to non-U.S. persons on an annual basis and reports the U.S. non-resident alien tax withholding and Foreign Account Tax Compliance Act withholding that you've done. So they're looking to require this electronic filing of returns. Another important provision, which didn't make it through in the reconciliation bill, but we know that there is still a lot of discussion about it, is this new potential requirement that financial institutions report cash inflows and outflows. This is a significant development, and there is some discussion around what the required threshold might potentially be, but they're looking to get information on cash that's going into and cash that's coming out of bank accounts. So if we think about that, they're currently looking at a $600 threshold that was proposed as a part of the initial tax plan. But there's discussions around raising that threshold purportedly to $10,000. Again, it didn't make it through into the reconciliation bill, but that doesn't mean, which I think is a common thing that we've heard, that it won't get through otherwise, right? So just something to think about. Also important development is a requirement that all payees that are receiving payments, reportable payments, provide a W-9 form with a tax identification number on it, signed under penalty of perjury. Under current rules that are in effect, you're not required to have this W-9 form for all types of payments. But what the government is proposing is, we want everyone to certify under penalty of perjury what their tax identification number is, to increase compliance with reporting requirements and to allow them to better identify whose income this is. So that would be a new requirement that could impact the data that you're required to collect and for whom. Also, finally, payment settlement entities. There's a lot of focus around the reporting required on IRS Form 1099-K, which is a form that's used to report payments that are settled by third-party settlement organizations who are handling, credit cards and different payments. If you have an entity in your structure, for example, that runs a platform for example, where payments are made and settled. If you think about the new gig economy and our Uber share rides and different platforms that allow you to match a customer to a service provider, and you handle the processing of the payment. The government feels that but for this required reporting on Form 1099-K, they'd have no insight as to what those payments are. So they are focused now on trying to understand what those payments are, who's making them, who's receiving them. The current threshold for Form 1099-K reporting is 200 transactions or $20,000. That's the current threshold. These proposals would decrease that threshold down to $600 for federal tax purposes, which is really important because it means that the volume of 1099-K forms that you might need to file going forward will significantly increase. They're also proposing capturing additional information than what was previously required on these forms, like gross purchases and payments to and from foreign accounts, which wasn't previously required to be reporting. You didn't have to do 1099-K reporting to non-U.S. people. But again, a very important development that we're keeping our eyes on. We do expect to see and hear more on that. It was included in the reconciliation bill, included in the proposed tax plan initially, so look for more there. Just thinking about the federal tax requirements is one thing, but you also need to comply with any state information return and withholding requirements. And that means that you need to consider what the states require. And each state may have a different reporting requirement. They have different thresholds in some instances. Not all states participate in the combined federal state reporting program, meaning that not all states accept 1099s that you file to the U.S. government, for example. They have a separate direct reporting requirement. And so if they don't participate in the combined federal state filing program, well, first off, you need to know that. Secondly, you need to have a good grasp of what states your newly acquired entity may be in, may be operating in. And one key example here is Form 1099 NEC. So in the past, last year, the U.S. government didn't include the 1099 NEC form in that combined federal state filing program. And it left many companies scrambling to try and figure out what are my state reporting requirements, because the rules varied with respect to this form from state to state. Some states required reporting in the event that you had someone who had an address in that state. Others may have required reporting if you reached a certain threshold. Others require reporting if you withheld. And so the good thing is that the IRS recently announced that the 1099 NEC form will be included in its combined federal state reporting program. But there are some states that haven't released guidance yet. So you'll need to continue to monitor changes in your data requirements for those states and to know when you have a separate 1099 NEC filing requirement. And that NEC form is used to report non-employee compensation. So if we think about going back to the point around independent contractors and your vendors that you're paying who are providing services for you and may be providing services for a buyer, for an entity that you acquire as a buyer, then you need to be prepared to deal with those requirements. I also mentioned the 1099-K, which is the payment card and third-party network transaction reporting, and the fact that there is a lower threshold there on the federal side. Some states will also follow that mandate and may move from the higher $20,000 or 200 transactions down to this $600 or more reporting requirement. Oh, and did I mention that there's no minimum number of transactions? So that's going to be important to think about. These changes may potentially result in more data that you need to report. There may be different naming conventions across multiple systems. And as George mentioned earlier, that's going to be really important to think about. So let's move into just what this solution is. George, would you like to talk about the Alteryx solution?
Yeah, thank you, Ari. I think I described Alteryx a little bit previously, and this is a little bit more detailed illustration, and I can talk about some of the ways it works and the tools that it uses. Essentially, like I said, it's an ETL tool. It's designed to extract data either from Excel files, CSV, text. It can hook directly up to systems. It can go out to the web, and it can scrape data from websites. It can be used in a lot of different ways, but the beginning of the workflow is always importing data. Once the data is read, in our case, in the information reporting 1099 workflow, we're trying to combine several different reports based on key fields. So if you have 2 companies or 30 companies that have been generally decentralized outside of like a shared service center, they're all on different ERP systems, however the setup might be, what you'll typically have is for each of those companies, they'll have a key, like a vendor ID number. But then that vendor ID number will be referenced in transaction data, and it'll be referenced in a database of the vendors themselves with addresses and phone numbers and other details that were collected during the onboarding process. Sometimes if they're dealing with individuals, they might have a separate database that has social security numbers and other PII, private information. And so all of those reports for the compliance reporting process have to be brought together. And in the case of 2 companies or 30 companies, each of those sets of data have to be sort of independently aggregated, and then aggregated again all together, so that you can get kind of the big picture and summarize everything for the reporting. In this case, we're taking data from company A, data from company B, a contractor list, and transaction data. We're combining it with these purple tools in the window on the left here that functions sort of like a VLOOKUP tool. So we're using their own individual style of contractor ID number to agree to transactions to the contractors. Doing a few steps here to cleanse the data, eliminate white space, capitalize names, things like that. And then the last tool there, the one that looks kind of like it's purple with the DNA sign, is combining the data where we're just stacking it directly on top of each other, where we have now 2 sets of data with common field names. So, name is the same across both of the structures, tax ID number, amount, gross tax withheld, state, and address information. So then all that data can just be stacked on top of itself. And in this case, to the extent that you have, like I said, 2, 30, 60, it's just kind of more or less a copy and paste exercise to add additional reports into the workflow. And I'll discuss some of the sort of calculations and then the reporting tools here on this slide. Once you have all your data stacked, presumably it's by transaction. So if you had multiple transactions with a contractor, there'll be multiple rows of data. If company A and company B also interacted with the same contractor, you couldn't typically connect those by their contractor ID, because if they're coming from different systems, they might use a different naming convention or different style of contractor ID. Or even if they use the same, if it's just 0001, 0002, because their systems originated at different times, obviously the contractors are going to be different numbers, right? So at this point, we have everybody's tax ID number, presumably, and we can sum the data by their tax ID number. And so we use that as the primary driver from this point on. consolidate the by tax ID number. We do a couple of operations here related to kind of format the address in the way that the IRS wants to see it. You might have in one report, it's coming in as, the full street address, and others it might be the street numbers in a different column than street name and the apartment number or suite number. So we get all that set up the way that it needs to be displayed on the form. At the very last blue tool there is really to sort it, and then there's a couple tools here to report it out into a table that then would be used for it would be imported into the compliance software in the appropriate format. So now I'll go over here to the demo, and I'm going to share my screen. Here we go. So this is the style of the workflow is a little bit different than the screenshots, just to kind of call things out and separate different groups of tools here. But what we can, I can first kind of describe the interface of Alteryx. This is where all the tools are here in the center here is the canvas. And essentially, in order to build a workflow, you just drag tools down from the ribbon and onto the canvas and connect them. You can see here in these green boxes are highlighted as imports of data. We have the 2 contractor lists, the 2 transaction data lists. We've got the payer information for the 1099. We've got the 1099K template, which is, I'll show you that. So this is a blank version of what's used. This is the upload for the compliance process. You can see these headers up here for the various, for the system to read each of the box items for the 1099 compliance. And we've got the payer information tab here, which will be used to enter the information in the system for that compliance. So that gets imported here, mostly just to get the headers and the structure for the workflow. And then we just have a month lookup tab here just to bring in, to look up months to the three-letter version. As far as consolidating the data, again, similar to those screenshots, what we've got here, and we can explore the data a little bit more in this view. As you can see, we've got a vendor ID number from the company A. These is kind of like a letters and numbers here, almost like I just used a random tool here, but it's like license plates. And then you get their name and their other data. And then in the company B, they use just a numbering system, right? So typically, this would all of a sudden start to pose a challenge consolidating the information. Transaction data is relatively similar between the companies, but you've got a date for the transaction, a type, amounts, tax withheld, and then this company just uses, we just have names here, but the tax ID numbers, I believe, are EINs instead of Social Security numbers. The contract list. So they use EINs here, Social Security numbers up at the top. All randomized data, of course, names are all random, nothing proprietary. So what we do is we take the data, we consolidate it, we cleanse it, we format the fields, we stack it, and then combine the data. And there's this box on the left. I don't really need that anymore. And we can look at the box on the bottom, which is the data as it flows through the workflow. And so you can see how the data is all stacked here. You get your vendor ID numbers by vendor, and there's about 1,000 rows or something. So now that we have all the data there, we go through the processing. Again, it's a little bit different. Add a little bit of complexity in this version. It's involved a bit since the screenshots, but basically break out the data by month, keep the totals kind of in a separate swim lane, bring it all back together, and consolidate the data again into a tool. So now we've got it structured with a recipient, so a list of recipients as is on that on the import tool. And you can see now that the headers down here at the bottom are aligned with the read with the import data in our compliance software is looking to read. And so we all we have to do once we get once we have the workflow established and we have the data brought in, is just click this run button, rerun, reprocess everything, and then what we end up with is so we've got the payer information loaded and all of the data by recipient, tax ID number, name, street address, by month, gross amount, number of transactions, federal tax withheld, state, and then, you know, to the extent there was additional information to bring in as far as the state tax ID numbers, other metrics. I know I think there's a couple special reporting items as far as like gross fees paid to attorneys. You could use if the client breaks out a transaction type that is legal services, you could call those out specifically and total them to bring them into the report separately, varying other specific information. So I guess probably have some time for Q&A, or Arian, do you have anything else to add on that?
Yeah, I think you know the key here is making sure that you've got a good handle on what your data is. And George, thank you for that demo. I think it clearly shows, you know, the power of this tool in helping you to be able to gather and consolidate the information that you'll need post-close to comply with these reporting and withholding requirements. Clearly, to the extent that you participate in carve-outs or you acquire new entities, you get rid of entities, you move into new jurisdictions, new states, you may have additional reporting and withholding requirements. And if you start with figuring out what your data needs are, you very quickly realize post-merger that those data requirements and those reporting requirements and withholding requirements may exceed what you have the capability of handling. Understanding what your requirements are, though, will require you to do an assessment. Look at where your withholding agents are, what the payments are that you're making, your payment flows, to identify where there may be potential gaps in your systems and processes for identifying payments that might be reportable, for computing any required withholding, for making sure that you know who your payees are and that there's an owner of those processes. To the extent that you have manual controls in place, those manual controls may present additional risk as your reporting requirements increase. And so, you know, thinking about where you need to start and what your reporting requirements are and how much data you're gathering and how you can bring it all together. George, I think, you know, that demo really emphasized just how much sometimes it can take to consolidate data. So I think we need to be mindful of that and be prepared with the solution.
And I think it's worth noting too that you know, tools like this aren't specific to information reporting. There's a lot of, obviously, you know, in the post-merger world, or in the case of companies who've been fairly acquisitive over the past few years and have several, you know, separate reporting units or business units that aren't on the same ERP system. These are challenges that tax, finance, and accounting face in many different ways. Getting information from all the business units, foreign companies, foreign tax packages, consolidating information, just digesting it in general and getting it in some usable format for their financial reporting or their tax compliance or their information reporting.
Yes, very important point. Thank you. Thank you there. I think it just really emphasizes the importance post-merger, right? Once the deal closes, you've got so many things to do. Thinking about where the data is and how you can get to it is not necessarily the best use of your time, but having a solution in place to help you to do that will help to mitigate the risk, help to manage your time so that you can focus on your bottom line. So compliance with these requirements, which we expect to increase, the enforcement that we expect to increase, we want to make sure that we help you to be prepared. So think about looking at where there may be potential gaps again. And going back to George's point, to the extent that we can, we certainly want to help you with utilizing a tool, a powerful tool like this for other purposes besides information reporting, because there are so many things that you need to focus on, and we think that this is important for you. You've got a limited window. We're now at November, so I assume that most folks are now thinking about how they can comply with these requirements and get these reports filed in January of next year, and be prepared for what the Biden administration and the U.S. government is planning around enforcement of these rules, but also to think about what other governments around the world are doing to ensure your compliance. So with that, I think we can open it up to see if there are any questions here. We're just slightly ahead of schedule, which I think is a good thing.
Yeah, so just a reminder to the audience that you can submit your questions. You can submit your questions using the Q&A manager on your screen. Simply type your question in and then hit submit. And I do want to remind the audience that this session did not qualify for CPE credits. That's why you did not see any polls. The remaining sessions today do, in fact, offer CPE credits. We hope that you join us for that. And a reminder that you can use the links in the resources list to the right of your screen, including the link to resume going back to the Tax Summit lobby, and also the networking lounge where you can join these presenters immediately following this webcast for additional discussion on this topic. I'm not seeing any questions come in at this time. Anything to wrap us up today?
I think that we had one question earlier regarding what type of data might need to be captured for purposes of the Foreign Account Tax Compliance Act. I'll address that one just really quickly. I mentioned that Foreign Account Tax Compliance Act requires financial institutions to report certain information on their account holders and investors for purposes of complying with these rules. And that information can include their profile, their name, address, their country of residence, for example, but it also includes information on the value of their accounts. And by account, we include debt and equity interests. So thinking about, their capital account balances and, what interest dividends you're paying out to investors and what's going into your shareholders' accounts. That's the type of data that you might potentially need to report. In order to comply with those rules, you also have to perform certain due diligence on your investors and account holders. And in performing that due diligence to determine who they are, and what country they may be resident in and where you need to do the required reporting, you'll want to capture that data in your systems in order to be able to comply with the reporting requirements. That data can change from year to year as your investors' information changes, as your shareholders' information changes. And so you want to be mindful of that and make sure that you've captured it, having an automated process for capturing that information, and that will be required at year end when you need to do the reporting. It makes it easier as opposed to at year end trying to gather it all. And if you need to report for multiple entities in your structure, it gets that much more burdensome if you don't have an automated solution that would help you to capture some of that information. So again, that same information would flow through to 1042 returns, which are used to 1042S returns, which are used to report information on payments to non-U.S. persons. And so very important to have a process for capturing that data. So just wanted to respond to that question. I don't think that there are any more questions in the queue. And so with that, we'd like to thank you today for spending the time with us to talk about managing post-merger risk, and encourage you to join us for upcoming webcasts on other global information reporting issues. Thank you.
Thank
Allison,
you so much
I'll turn it back
to our
to you.
presenters. Thank you so much. Thank you to our presenters and to our audience for joining us. And a reminder that you can join these presenters immediately following this event in the networking room by simply clicking the link in the resources list to the right. As we mentioned previously, this session did not qualify for CPE credits, so nothing to download at this time. But feel free to join us for the remaining 2 sessions today and the rest of this week to get that CPE credit. Thanks so much for joining us. We look forward to talking with you later this afternoon. Enjoy RSM Tax Summit Week.